Welcome, everybody. Thanks for this opportunity. Today, we want to talk about sort of the global regulatory environment. Before we get into that, just want to do a quick intro. My name is Bector. I'm a partner at Oliver Wyman. My particular area of expertise is within investment banking, capital markets, private equity, hedge funds, those folks, and focus on anything around technology and operations. Over the past couple of years, since the Dodd-Frank Act was signed into law in 2010, I've been basically working round the clock, trying to help investment banks figure out what the implications would be on their operations and technology. Also talking about the strategic issues in terms of the revenue and the margin compression that's essentially going to happen with respect to OTC derivatives as well as other regulations part of Dodd-Frank. Now, we all know all of the major banks are getting hit by a plethora of regulations. So you've got Dodd-Frank in the U.S., you've got CCAR, which is essentially the stress testing from a Federal Reserve standpoint, which requires operations and technology to be in place. You've got EMIR and MiFID II in EMEA. You've got things in Japan in terms of regulations. You've got Basel III, you've got FATCA. I mean, it goes on and on and on, right? And banks are stressed at this point in time to sort of battle these issues and sort of come together and figure out how best to work their compliance functions as well as their overall operations and technology to adapt to this changing regulatory environment. So we've got a great panel for you guys today. We're going to try to cover both regulations that are in the U.S., particularly Dodd-Frank Act. In addition, we're going to take a step back and try to cover a little bit around MiFID II and EMIR as well from a Euro standpoint. So I'll let these gentlemen introduce themselves.
Thanks, Raj. My name is Hurley, and I want to thank Ben, wherever he is, for inviting me back again this year. As I look around the hall and I see all these promotional banners for the sponsors, thank you very much. And I know we have a lot of vendors in the audience. And so I'm going to be shamelessly self-promotional and say that I'm involved in a very exciting venture at Boston University where we are bringing together all aspects of the university from all of the colleges, whether it's business or economics or engineering and even the medical campus and the law school. Wherever there's an element of the university that focuses or deals at all with financial services, my Center for Finance, Law, and Policy reaches out to it. We like to say we put the United in university. And I'm going to play the same, I guess, downer role vis-a-vis Dodd-Frank as I did last year, which is to evaluate it as a very problematic statute, the redeeming value of which is probably most found in the way it deals with derivatives, although that's a very complex issue itself. And in this audience, I have to say that notwithstanding the fact that we are all vendors, I guess it's a silver lining for many of us, the fact that Dodd-Frank and the many initiatives that Raj described create a lot of business opportunities. So I'm used to speaking before bankers and directors where those opportunities are viewed as a negative. But in this crowd, I guess it's not a bad thing. So we'll get into the detail and some of the strategic issues that Dodd-Frank and Basel III and so on present to you, but just let me say that I'm delighted to be here. And if you have any projects or issues that you'd like to see researched or explored in a third-party independent way, please get in touch with me at the Center for Finance, Law, and Policy, and we'd love to work with you and hear from you. Thank you.
Hello again. I'm Abramov. I work in financial services industry, and I represent ISACA, which is IT Governance, Risk and Control Professional Society with over 90,000 members worldwide, and our New York chapter is over 3,000 members. We will be talking now today, different from yesterday when we talked about enterprise risk management. We'll be talking about regulatory environment. These two things are really connected, and I think that we would be established some interesting points where risk management touches upon the ways how to manage the regulatory risk, which is the topic of today's panel.
Great, thanks for that intro. So there's no presentation, right? So let's, we're going to take your eyes off of the screen here. I do want to start out just, I want this to be a free-flowing discussion as opposed to us briefing you guys for the remainder of the 30, 35 minutes. So what I'd like to just kind of toss the question out to the audience, is there a particular issue that any of the folks, and I understand we have a majority of the vendor community, but perhaps we do have some of the representation from the banks and other folks in the industry. If there's anything around Dodd-Frank, anything around MiFID or MiR that folks are challenged with today, we're happy to take that question. If not, I do have some prepared questions, but I want to make sure we try to get the audience engaged. Come on, somebody's got to have something. Okay, I've got plenty of them. So let's just start out with, let's cover Dodd-Frank. And let's talk about what are the major challenges, Cornelius, that you've seen in terms of the regulations themselves and the implications on let's talk about the operations function within the banks.
All right. Well, I think on a strategic level, my problem with Dodd-Frank is that it was a missed opportunity. It creates massive over-regulation. I'm not speaking as some right-wing ideologue. If anything, I'm a left-wing ideologue. But it missed the opportunity to create meaningful structural reform, and instead, it embedded this notion of too big to fail systemic risk in our regulatory structure for the foreseeable future. So much of what you're talking about today, it deals with the macro-prudential restraints that Dodd-Frank imposes. Now, what are the missed opportunities that they could have taken advantage of in Dodd-Frank? Well, number one, they could have set in place mechanisms to cause too big to fail banks to become smaller and less complex. And I can get into a proposal that I and Bill Isaac, the former chairman of the FDIC, have put forward that would accomplish that without handing it over to Washington bureaucrats or creating some arbitrary mechanisms. But the large banks have to be smaller. Not to diminish any of the wonderful products that you have here, but at the end of the day, a lot of this comes down to human judgment. And you can have the best IT systems in the world, but if you have operations that exceed human judgment, then we're going to have the problem again. Another structural reform opportunity that was missed was the opportunity to consolidate regulators. The CFTC, the SEC should be one agency. There are only two agencies because they're each, the CFTC is regulated by the agriculture committees of both houses of Congress. Now that makes no sense to me. The banking agencies themselves should be consolidated. It's just, it defies imagination. So what does Dodd-Frank come along and do? But it creates two additional agencies, the FSOC and the CFPB, to regulate the consumer side of things. In my very straightforward view of the consumer side of things, and having worked at the Federal Reserve Board in Washington for 8 years, yes, the Fed did an awful job of regulating on the consumer side. Why did it do an awful job? Well, for almost 20 years, it had as its chairman a gentleman for whom regulation was anathema. Congress directed the Fed specifically to enact regulations to control subprime and predatory lending. It's called the 1994 Homeowners Equity Protection Act. And the chairman of the Federal Reserve for 20 years refused to implement that statute. Well, that doesn't mean you need a whole new bureau. What you probably need in that case is a vice chairman of the Fed designated statutorily with responsibility to be the consumer vice chairman, similar to what the statute does with respect to bank supervisory activities. By the way, a designation that our president has yet to make at the Fed for fear that the most obvious governor would not be confirmed in that regard. So, so there are tremendous missed opportunities, and we'll be paying the price for these missed opportunities for many years to come.
If I could just add to that in terms of some of the implications from a technology and operations perspective, which I think might be interest to the vendor community here. If you look at some of the major areas, and Cornelius touched on a couple of them, one of them is essentially the resolution planning, which is the living will, unwinding risky operations from less risky operations within the banks, right? So separating retail banking from investment banking and proprietary trading and so forth, right? If you think about that in terms of how intertwined the banks are today within individual banks and then also together as an industry, unwinding that so that we don't have a Lehman again is incredibly tough, right? In terms of the processes as well as the technologies, right? So if there's some technologies out there that can help us disintegrate the systems and the processes, I think that would be a home run for any vendor out there in the industry, right? So point number one. Point number two, around the reporting of OTC derivatives to the swap data repository, right? That is a requirement from the CFTC to get more transparency into derivatives, right? What's going on from a volume perspective, what's going on from a notional value perspective, what's going on from a pricing perspective of individual contracts, right? Now that is a pretty big departure from where we are today, right, in terms of very limited transparency within the OTC derivatives market. The opportunity there essentially is to create some sort of a technology, a standard technology that's regulations compliant, so CFTC compliant, as well as SEC compliant, right, to take that derivatives data and post it to the swap data repository. Today, the banks are having to do that on their own as an internal build, right? But everybody has the same requirements in the industry, right? So there's an opportunity there to have some sort of a, what I call a Dodd-Frank reporting engine, right? That sits within the environment to produce that set of analytics that get delivered to the swap data repository, right? And then you have a couple other things around workflow within client onboarding and suitability, right? So so let me just take a step back. There are additional suitability requirements as you bring on a customer for derivatives trading, right? So today, very few solutions in the marketplace with respect to capability to shepherd a client through the onboarding process for derivatives trading, right? Very difficult to do. There's a lot of documentation that goes along with it. There's liability that the dealers actually have if they get that process wrong or incorrect, given the Dodd-Frank regulations, right? So there's an opportunity of some sort of a workflow type capability that allow the banks to do that easier and reduce their risk, their business risk as well as financial risk in terms of there's fines associated with those types of non-compliance. I see a question.
Yeah, are you able to speak to the common clearing platform issue that the market participants, swap dealers are going to deal with? And I know there's vendors in that space. Are you seeing global banks actually look at vendors, pick one, move forward with implementation? Could you comment on that?
Sure. Just to rephrase the question, this is all about, so things are moving electronically. So all the OTC derivatives are moving electronically to what's called a swap execution facility in the US, and then in MiFID and EMIR, it's called organized trading facilities, or OTFs, in Europe. So basically what that means is you've got to have a common execution platform, but then whatever's executed electronically has to be cleared now, right? So it's got to go through a clearinghouse essentially, right, to reduce the counterparty risk that is so prevalent in the marketplace today with respect to OTC derivatives. So there's a couple players within the execution space. I'm going to try to separate the problem. There's execution and then there's clearing. There's a couple players in the execution space. One of them essentially is market, and there's two schools of thought in terms of how to go about putting together the execution model. Right? The first is you go to point. So you've got your Bloombergs, your Javelins, and others that are essentially swap execution facilities out there that provide electronic trading. Right? That's number one. Number two strategy is through market, which is a hub, and you have all the different swap execution facilities as a spoke in that hub. So you just have to make a one connection from an operational and infrastructure standpoint to get access to all the different swap execution facilities, right? So those are two schools of thought. Market is a pretty big player in that particular space. It remains to be seen what shakes out. There's backing from the individual investment banks around both of those strategies, but it's unclear what's going to shake out at the end of the day. Clearing. So there's going to be mandatory products that need to be cleared that are going to be mandated by the CFTC for clearing. There's a couple schools of thoughts there in terms of going through a clearing broker as well as going directly to a clearinghouse as a member of a clearinghouse. I'm not particularly familiar with any of the technologies that are there in terms of a common clearing broker. I have heard that, again, the large banks in the industry are having a joint venture to pull together a common clearing platform. But again, I can't speak to that as much as I would have hoped or liked. But I can definitely speak to more of the execution space. So just to, I guess, set the context for the audience, that's essentially what's happening from an execution and clearing perspective. But unfortunately, I don't have any names of vendors in the clearing space. I don't know if the panel's...
If I could just follow up on that, not from a technical standpoint, but in terms of one of the many gaps that Dodd-Frank leaves behind. And I think this gap was revealed by the recent JP Morgan fiasco with the London whale. And I'm addressing this now as a question back to you and to everyone here. And I'm speaking as a director of two fairly significant banking organizations. And that is what Raj has just described is the plumbing, the infrastructure of how we are going to regulate this opaque market, clearinghouses, repositories, so on. But that doesn't address the boardroom or the managerial ignorance about these products at all. And if you were to come up with an educational product that took what Raj is describing, which is designed to create transparency in the marketplace, but face it in a different direction, away from the marketplace, and try to educate directors and senior managers about these products, I think that would be a winner. And I just throw out a challenge. I'd be delighted to work with anybody that wanted to take on that challenge, again, from the standpoint of a third-party independent organization.
Excellent. Another question? Yep.
Sure. Well, without risks, there is no reward, of course, and the whole financial industry works on two sides of a transaction. So obviously, you cannot eliminate the risk, you need to manage the risk. So when you mentioned about dark pools, I think there's two sides of that. For one side, there are clear tendency in increasing trading, and may not be steadily, but we see the increasing trading in a dark side rather than a light side. From another point, the government making an effort, to move everything into standardized and more open form of trading. So if it was mentioned, so best execution is required. However, I think that we have these two forces which counterbalances each other, and I do not believe that you would be able to open up everything and eliminate alpha and eliminate search for liquidity, eliminate the opportunities which people are looking for. It's just against human nature and against the tenets of the financial industry. So I think that that we will continue seeing this two different forces acting in a variety of the ways, but I think that the status quo more or less will remain the same. What's your...
I might just add to that is you have to focus on the subsidy that the too big to fail banks receive. A recent report out of the IMF pegs the subsidy at anywhere between 60 and 80 basis points, which is enormous in banking terms, right? It's enormous. And it so distorts the pricing mechanism that we can never get to what you're talking about, an accurate risk premia regime, as long as the taxpayers are providing this subsidy year over year. What Dodd-Frank does is it sets the regulators upon a mission impossible. They have to hit the target right on the button between allowing too big to fail banks to continue to operate with this subsidy, this 60 to 80 basis point subsidy. And if they do so successfully, then they acquire every other competitor, right? Or the other alternative is to regulate the bejesus out of them and create unsuccessful organizations and destroy our economy in the process. Dodd-Frank instructs the regulators to go right down the middle of that devil's choice, and it cannot be done. A recent report out of the KWG group in London earlier this week pegged the compliance cost, largely IT, for the European Union banks over the next 3 years at $62 billion. That's almost half of the Greek bailout. We can't, this is unsustainable to allow the largest institutions, and I'm not talking about the Dodd-Frank too big to fail, the 50 billion, that's nonsense. That's pure legislative fiction. I'm talking about the real too big to fail banks, the top 6 in the US and the so-called G-SIFIs that the SFB has named. Those are the too big to fail banks. Those are the ones that are getting the subsidy. Those are the ones that are distorting the markets and preventing market discipline, which you and I would both like to see play a role here, from playing a role.
Excellent point. Other questions? One of you guys want to take that on?
The great question. My problem with Dodd-Frank and to a certain extent with Basel III and Basel II, which had its own tortured history. Thank God it was never implemented, or we would have been in worse shape than we were through this financial crisis. The problem I have with Dodd-Frank is that it takes capital, which is a very, very blunt tool, very blunt in the supervisor's toolbox, and it elevates it to being the most important part of financial supervision. And I would argue that the most important part of bank supervision isn't capital, although it is an important part of supervision, but rather it is the supervisory presence, the actual examiner on site, the intimate knowledge that apparently the OCC did not have with respect to JP Morgan's CIO operation in London, and we could all come up with a dozen examples on our own of where regulators were asleep at the switch. So the earlier speaker referred to the stack of documents that make up Basel III. In its most basic form, what you want to do with capital is it's like that part of Dodd-Frank that says stick skin in the game when it comes to mortgages. You want it to convey skin in the game by the shareholders, but when it takes a stack a foot and a half high to describe, and the board, again, going back to the board of directors, doesn't understand how it works, couldn't understand how it works, then to lean on that read, that very, very complicated read, to protect us from the next crisis, I think is misplaced priorities.
Just to add to that, I mean, I guess the way I sort of broke it down in my head is, Basel Accord essentially targets the capital, tier 1 capital risks, right? It doesn't tell a bank how to run their operations, right? And it doesn't give the banks the guardrails in terms of which to run the operations and their technology, right, and their compliance. Dodd-Frank, on the other hand, says, well, Basel is addressing all the capital issues, right? So if you have an OTC derivatives, there's an extra capital charge on top of that, right, to sort of to sway you from being more mindful of how many and what types of derivative transactions you get into. So Dodd-Frank says, well, look, we're going to give you some guardrails, at least the intent is there, to give you some guardrails from an operational perspective and a technology perspective. And in the process, we want to get more transparency into this market, right? That's the way I sort of look at it. Basel III is capital focused, whereas Dodd-Frank is trying to come to the next level in terms of operations and helping you, providing you guardrails for your operations and technology functions, right? That's the way I kind of look at it. Now, could the global regulatory bodies be a bit more collaborative in defining these things? Heck yes, right? I think there's a significant disconnect between Asian regulators, which they're on a wait-and-see sort of an approach, the European regulators, and then the U.S. regulators, right? They're having they're having discussions at the G20 level where people are at a very high level thinking how these things are going to come together. But when you read into the details, massive disconnects, massive disconnect. I'll give you a very prime example between Dodd-Frank and MiFID in terms of collateral for OTC derivatives, right? Dodd-Frank says it's going to be cash or treasuries and select agency bonds, essentially, right? That's pretty much it. MiFID, on the other hand, doesn't really give you any guidance. They're saying, well, we're going to restrict it, but we're not sure what it's going to be, right? So now what you've done is, what the regulators have done is, they provided a massive arbitrage capability, right? So if you want to execute an OTC transaction, run it out of London rather than New York, right? That's how things are sort of going. That's how the banks are thinking about it these days, right? Now we know, in reality, things will sort of balance out in the long run, but in the short term, we're going to take a hit from a New York perspective in terms of derivatives trading and the volumes and then the profits that go along with that, or the revenue streams that go along with that, right? So there's these implications at the low level. The regulators are not communicating. At the G20 level, everybody's in agreement that we got to have transparency. We need to reduce systemic risk and those types of things. But those things need to translate into real meaningful details that just aren't there yet in the environment.
Well, with all that said, Dodd-Frank is a law of the land, and some provisions already starting to be effective. So I think industry is working to implement that provision. Even there are some expectations that the law may be modified. If we'll take example of a healthcare law, many states are against healthcare law, but they're setting up their insurance exchanges anyway to be prepared. So the same thing in the financial side of industry. This is a regulatory risk management. Industry need to be prepared to set up appropriate controls and structures to be compliant in a strict interpretation of the law, not to be caught on the other side of the law. So if we'll, I can bring an example. In the late 90s, FDA came up with a regulation for the technology, which called 21 CFR Part 11, electronic records, electronic signatures, which seemed to be at that point very onerous type of regulation. The lobbying was successful, and a lot of this regulation was actually diluted. I was part of that lobbying when I was working in the pharmaceutical industry. I was head of a IT regulatory program. We cannot really always expect that this effort by the lobbying group, by the industry, by academia would change Dodd-Frank. So we need to be prepared, and I think that over the last 10, 15 years, the structures, organizational structure within the company has already grown to deal with that, something which I call regulatory fatigue, because yet more and more regulations and law being passed, and then that mandates adding up. So organizations need to find the ways effectively dealing with this type of challenges, and run it as a program, which is a continuous process, rather than to try to address or hope that the regulation will go away, and we will not need to spend anything to address those. So I think that important thing to understand that even if we disagree with some of the things, we still need to be very well prepared and build controls and see how to make it an effective way to deal with the new regulations.
I'm shocked that you would imply that financial institutions chartered by the government would be lobbying the very government that chartered them. That just doesn't happen in this country. I'm reminded of when Fannie Mae and Freddie Mac were put into conservatorship back in 2008. One of the dictates was that they had to stop all their lobbying activities.
Did it really happen?
And here we are in 2012, and we have institutions that are receiving the same kind of taxpayer subsidy that Fannie Mae and Freddie Mac received, because of the implication that the taxpayers would bail them out in the end, and yet they're massively lobbying government to go light on regulations. So in some ways we haven't really learned that much.
We've got a Take a gentleman there.
Taking a long historical view, obviously with the recent situations in the early 2000s and then Sarbanes-Oxley and then, more recently Dodd-Frank, is there anything that you can see as positive? Is anyone going to look back and say anyone did anything right nowadays, regulation-wise? Or just always reacting to the last bad thing?
Well, we do have lobbyists, and we do have politicians who listen to lobbyists and rely on their contributions. I think the Dodd-Frank contribution in the area of derivatives is helpful. I think the idea in Dodd-Frank that shareholders should have a say on the executive pay, I think is a good thing. I think proxy access by longstanding shareholders to that mechanism to breathe the fresh air into boardrooms is good. I think there's some positive things. This notion that you should just repeal Dodd-Frank is not a credible notion. You have to have something. We can't have gone through the crisis that we went through and have nothing. So it's a little bit like healthcare in that regard. You can't just repeal Obamacare and say that's the end of the discussion. You have to have a substitute. I have my own idea of what would be a positive outcome, and if you'll bear with me for 30 seconds, I'll describe it to you. And this goes back to the subsidy notion. The truly too big to fail banks receive tens of billions of dollars of subsidy every year from the taxpayers, a la Fannie Mae and Freddie Mac. My idea, and I share this with Bill Isaac, the former chairman of the FDIC, is to not tax that away because that's a non-starter in today's political environment, no new taxes and the Club for Growth and all of that nonsense. But just identify it on the books of the too big to fail firms as the taxpayer subsidy. Let it count as a reserve for capital purposes. And say that that cannot be touched for dividends or for share buybacks, that can only be returned to the shareholders in the instance of a divestiture of a company or a spin-off of an asset, okay? Now what you would have is over time, that subsidy reserve would accrete, and it would become very large very quickly. And shareholders, not bureaucrats, not the Treasury Department, not regulators, shareholders would go to boards and management and say, hey, we really need to right-size this organization. That subsidy reserve has to be put to work, right? Otherwise, all the performance ratios are wacky. I think that's the way out of this dilemma and to return to capitalism as we used to know it.
I'm glad you mentioned Sarbanes-Oxley. My view of Sarbanes-Oxley is a lot more positive than Dodd-Frank, because I think there was a lot of tangible benefits for the industry, which helped really to organize the process, document the process, establish right control, reduce fraud, really bring accountability and responsibility to the top-level organization. I think it did help to improve the health of financial markets. It helped improve stability and trustworthiness of the annual reports, the trustworthiness of annual reports, and overall stability as related to the company standing. So I think there is a lot of benefit there. So the money, I think, mostly were invested well. As in any investment, you need to look whom you would entrust your money to help with your compliance. And but I think that overall it was a positive impact.
That's an excellent point, and that sort of hits to the heart of the point that I made with respect to global collaboration amongst the regulators, right? Because you want to minimize the arbitrage opportunity across U.S. or North America in general, Europe and Asia with respect to a regulatory arbitrage, right? So what's going to happen is if we don't get our act together globally, everything's going to move to the Cayman Islands, right? Limited regulatory capital requirements, limited risk management type capabilities, right? I mean, that's our institutions are compensated or incentivized to find the most efficient places to do business, right? And if that's not North America, and that's not Europe, and that's not Asia, it's going to be some other part of the world that doesn't demand such high regulatory requirements and risk management capabilities. So what we're really doing is transferring the systemic risk somewhere else in the world, right? That's essentially what's happening. So if you sort of, so that's a global macro perspective. If you zoom in terms of the derivatives regulation as an example, we're essentially moving systemic risk from the banks to the clearinghouses, right? Because now we're going to clear everything. So the counterparty essentially is the clearinghouse. And that's where we're essentially moving the risk to in terms of derivatives transactions, right? So someone at some point in time has to take on the risk, right? And I think what we need to do from a regulatory perspective is try to figure out who is best equipped to manage the risk, because that's what financial services is all about, right? Risk and reward, right? And being able to manage that. And who manages that effectively and most efficiently wins in the marketplace, right? So we're playing with the fundamentals of the financial structure, essentially, right? Given these regulations.
Just, you know, this was the dichotomy, is that you have over-regulation, and then through regulatory arbitrage, if you over-regulate, then they'll end up in the Cayman Islands. This goes back to systemic risk. The monetary authority of the Cayman Islands, or the Cayman Islands Central Bank, is hardly in a position to bail out a systemically important institution. So that's the trade-off today, is if you go to a less regulated environment, whether it's Cayman or Singapore or somewhere else, do you give up your subsidy in so doing that? After the Continental Illinois near failure in the mid-'80s, the phrase was coined by, I think it was Jerry Corrigan, then president of the Reserve Bank of New York, called constructive ambiguity, right? And that was designed to convey the impression that, yeah, the central bank is there, and yeah, it might bail somebody out, like a Continental Illinois, in extremis, but don't count on it. And for the most part, the markets didn't count on it. We have turned constructive ambiguity into an entitlement. We have made it a lead pipe guarantee, and this is what Dodd-Frank does, unintendedly so, but it's a lead pipe guarantee that these institutions now, because they're even larger, even more complex, even less manageable, will be subsidized. And this dilemma that the regulators face about, if I over-regulate, is Barclays going to go to Hong Kong or Shanghai? I don't think they are, because in doing so, they'd give up that 60 to 80 basis point lead pipe guarantee that they get.
Do you believe that allowing Lehman to fail was helpful to decrease moral hazard?
I think it was, but the price we paid was just intolerable. I think Hank Paulson probably wouldn't say this, but if he had a do-over, he would do it over. And the Fed and the Treasury claimed that the reason they let Lehman go was that they didn't have the legal authority to do it. I think that's not right. They did have the legal authority to do it, and I think the markets and our economy wishes now that they had intervened in the Lehman situation.
I agree.
I think we can do we have a question, time for one more question, or yep, maybe one last question, and then we'll wrap it up. Or we can wrap it up now. Thank you very much.